Let's get straight now, though, to the market and this rally to end the week, which started after a cooler than expected inflation read, but really took off after Chicago Fed President Austin Goolsbee told Squawk on the Street this morning that rates could sure come down more. Take a listen.
They think that the ultimate rate is around 3% with inflation of 2%, a real rate of 1%. We're still above that, so I still think it's meaningfully restrictive, and that's why I say over the next 12 to 18 months, if conditions keep on the way that they have over the last 18 months, I think rates come down a fair bit more.
Right? Exciting. Joining us now is Paulsen Perspectives author Jim Paulsen and Unlimited CEO and CIO Bob Elliott. Guys, happy Friday. Jim, even with all of this done, you think a noticeable growth slowdown is coming in the beginning of 2025, which will cause an S&P correction, drop of at least 10%. Then you think the market covers. So if you're at home, do you sell anything now or just buy big dips?
I don't think you, but I think, forecasting short-term corrections, John, is always really perilous, and I wouldn't advise doing that. I wouldn't raise a lot of cash. What I would advise that maybe investors do is defensive sectors have just gotten really beat up. They're down on a relative basis dramatically. The utilities, the consumer staples, pharma, S&P high dividend, high quality, those kind of names you can look at, and maybe sell out some of the cyclical stars a little bit or lighten up on something like consumer discretionary or some financials that have done really well, and just move the portfolio. It's still invested, but move it a little towards more defensive posture, because we haven't had a correction since October of 2023, and while everyone feels that things are good now because the Fed's easing, most other things are tightening. As soon as the Fed started easing, bond yields have gone up almost a full percentage point on the 10-year. The dollar in real terms has soared, which is a really contractionary force on industrial production and commodity prices. Money growth is only 3%, John, year on year. Nominal GDP is 5%. And whenever money growth is less than nominal GDP, real growth slows dramatically, up more than 1%. Over the next year, at least since 1960. So I think we're going to have a respike of recession fears again, and then we're going to get a more dramatic downward move in the rate structure, which will bring that rally in the second half.
Okay, Bob, what do you say for 25? You're continuing to preach risk management, diversification, even though it's not as exciting as some of the other options.
Well, I think the biggest thing as we enter into 2025 is it's time to curb your enthusiasm about this economy. I mean, we've seen real GDP prints above 3%. We see priced in earnings expectations growth in 25 in the stock market of 17.5%. And now we basically are having an interest rate curve that's pricing in no more or very few, essentially one cut from the Fed. You put that together, basically, the U.S. economy has to perform at perfection in order to meet all that series of expectations. And when you look at what's going on sort of cross asset, that dynamic really favors at this point bonds and gold to some extent relative to stocks, where basically any sign of a growth slowdown, you're probably likely to see some amount of rally in the twos, a little bit of a rally on the long end, and some stocks coming under pressure early in 25.